Hello, I'm Tony Marino, President and CEO of Tenaz Energy. Thank you for joining us for our Q4 and year-end 2024 results. I'd ask you to first note our advisories on forward-looking statements. Then I'm going to start with a summary of our operating and financial results for the quarter and full year. Production for the fourth quarter of 24 averaged 2,814 BOED. That's up 11% from the Q3 24 production level. The increase in production driven by the drilling that we executed in Canada, 2 wells during Q3. Each of these were multilateral wells in the Ellerslie Formation. First was a 3-lateral well, the second was a 4-lateral well. Of course, using these multilaterals, they're all unstimulated. We got 2 good wells. The first one averaged 344 BOED in Q4, particularly strong result. And of that oil equivalent production, 92% was oil, 8% was gas. The second well, drilled as a follow-up to that well, had a Q4 rate of 106 BOED. 69% of that oil equivalent rate was oil, remainder gas. Both wells have a pretty stable water cut. The first well quite low at 35%, that's a stronger well. The second well stable at about 80% water cut. If you put the 2 wells together and look at the current production, it's about 360 BOED as of right now. And in that oil equivalent total, 83% would be oil, 17% gas. The oil gravity is 26 API. Again, Ellerslie Formation, not the Rex that we had previously been drilling. And we have an 87.5% working interest in these 2 Ellerslie A wells. For the full year in 24, production was 2,688 BOED. That's a 10% increase from 23. That increase really driven by Canada. We had about a 16% increase for the year 24 in Canada compared to 2023. We were basically flat in Netherlands production. And the big driver of that organic growth in Canada with the drilling I just talked about. And of course, we had the effect of an end of year program in the Rex in 23 that helped the 24 rates as well. So a good year, I think, with respect to production growth. Again, driven by this multilateral drilling, those wells quite economic. DSET costs under 3 million Canadian, so quite good production efficiencies, and I would expect quite high rates of return and pretty rapid payouts. With respect to FFO, or funds flow from operations, in Q4 24, we recorded 8.3 million Canadian dollars. That's an increase of 147% from the third quarter of 24, with the big driver of that being the increase in production that I just talked about. And also we benefited in this year's quarter with a prior period tax recovery. For the full year 24, we had 24.5 million Canadian in FFO. That was down 15% from 2023. Drivers for that were lower natural gas prices in 24 for both Canada and Netherlands. We had higher OPEX, particularly in the non-operated Netherlands position. And we had higher transaction costs that are being recorded as a result of the M&A effort, especially the NOBV transaction that I'll talk about later on. At the end of the year, we had 10 million in positive net working capital, and we have 180 million in cash and restricted cash. Recall that we issued 140 million Canadian of long-term high-yield notes in November 24. We haven't really employed that money yet, so it is on the balance sheet as cash. And the net effect of the borrowing and the cash that we have, along with the impact of having placed a deposit on NOBV, is that we ended the year with a 10 million positive balance in net working capital and a substantially larger number recorded as cash and restricted cash. With respect to our stock return in 2024, we had a 257% total return. That was all capital appreciation, no dividends paid. That return placed us at the top of the 57 E&P companies that are listed on the TSX. And if you look at the entire TSX, over 1,800 issues in all the sectors, we're easily in the top percentile of TSX companies. So that summarizes our operating and financial results for the year. I'm next going to talk about our year-end 24 reserve report. And we've got a couple of pieces I'm going to cover with respect to reserves. When I talk about year-end 24 reserves, of course, it only includes the assets that are already in the portfolio. This would be assets that we inherited from Altura and the acquisitions that we have closed, a couple of them in the Netherlands and a small one in Canada. So this is what is in the portfolio as of today. Does not include NOBV. I'll talk about NOBV reserves in just a minute. So year-end 24 PDP reserves were up 3.5% year over year. We had a PDP recycle ratio of 2 times, indicating good cash generation per dollar of investment. If you look at the total proved and the total proved plus probable levels, 1P was up 10% from the year earlier in volume. 2P was up 14%. At the 2P level, this represents replacement of 306% of production, and we recorded a recycle ratio based on FD&A cost, finding, development, and acquisition costs, so not just the organic activities, but also the impact of the minor acquisition that we executed in 24 in Canada, leads us to a 2P FD&A recycle ratio of 2.1 times. Again, I think that's quite a strong metric representing good cash generation for each dollar of capital employed. The reserve book valuation, again, I didn't mention it earlier, but this is all based on the independent analysis of McDaniel and Associates, as has been our reserve engineering firm throughout our history. The 2P ATAX NPV 10 in this year's report was $206 million. That is about a 45% increase over the year earlier. And our 2P RLI, 16.2 years. And to arrive at that RLI, we base it on the Q4 24 production rate. We've got a series of graphs and tables shown on slide 6. We point out in the pie chart that the big majority, a little bit over 3/4 of our PDP reserves, are in Canada, remainder in the non-operated position we have in Netherlands. If you look at the time series on the lower right, it illustrates growth in each of the RCATs, PDP, total proved, and total proved plus probable throughout our history. So all of the reserve categories increasing each year since we did the recapitalization of Altura. Those values in the graph are a combination of the Canadian position and the non-operated Netherlands position. And then in the table on the upper right, we summarize our FD&A costs and the resulting recycle ratios using both organic activities, which is the F&D cost, and the organic recycle ratio, and the FD&A cost, which includes both organic investment and acquisitions, and the resulting FD&A recycle ratio on the far right. Pretty strong set of numbers and pretty good growth in reserves. Next part of the reserves I'd like to discuss is just to is going to be included in the next section, which is our NOBV acquisition update. So this is the NOM offshore BV share acquisition that we announced this summer. So to start off, before we get into the reserves, I'll just point out the status of the transition activities and expected closing. We received approval from the Netherlands Authority for Consumers and Markets on August 5th, 24. This really is a test of market concentration, which we got approval on that basis shortly after we made our announcement. Since then, we have been conducting transition activities, a wide range of work that involves HR work, IT changeover, preparation of all of our operating activities, onboarding the people and suppliers, quite a large project. Our timing to close has not changed. We've consistently said mid-year or earlier, and we're reaffirming that expected timing now. As I think you're probably aware, the effective date of the acquisition from an economic perspective is January 1, 24. All of the cash flow or the free cash flow that we get between that date of Jan 1, 24 and closing, mid-year or earlier, is going to be reflected as a reduction of the purchase price. And you may recall in some of the previous presentations, we talked about the various forms of consideration that we have on this transaction. And we did place a 34 million Canadian deposit at the time that we signed the definitive agreements in July last year. The additional informational item in this release is that we commissioned McDaniel to do an independent report that really updates the reserve picture at NOBV. In this report, it really rolls forward 1 year the start date of the evaluation, makes it consistent with how we're reporting the reserves in our actual owned portfolio as of today. The report that we had at the time we made the announcement of the transaction in July 4 had a Jan 1, 24 start date that was consistent with the economic start date of the transaction. We're almost a year later, and as is customary, we've made this report with an effective date of year-end 24. Even though we did roll forward the start date, we had an improvement in reserves in the key categories, and we reported as of year-end 24, based on McDaniel's independent assessment, 55.7 million barrels equivalent in the NOBV asset base. 99% of that is TTF gas, and that reflects 155% reserve replacement from where we were at in the report in July 24, using the January 1, 24 effective date. The ATAX NPV 10 at the 2P level is also up in this report, up about 14% from where we were at before. Now, the new report does include 2 new development projects. There's a tie-in of a previous gas discovery, tying in an idle well that will occur, we plan to have happen in the future, and a infill well in one of the pools. So there's an addition of 2 projects. There's still a lot of projects that aren't reflected in the report. These may qualify in the future as reserves, or they may qualify as resources at such time as we commission an independent report on resource totals. But there is potentially more to reflect in the reserve report than what we have right now. In any case, there are a couple of additional projects that have been included in this report. There's been a change in pricing, change in a variety of cost factors. There's accretion of discount in the change of the effective date, and then there's the lop off of the cash flows in 2024 as we move the data forward 1 year. And if you take all those factors together, we're up about 14% from the ATAX NPV 10 that we had in the previous report. So we're very excited about NOBV, and we're very, very positive about the human resources that are going to be joining us in this deal. Over 200 new colleagues, a lot of great suppliers in the Netherlands, a great deal of support, I think, from the rest of the industry and from the Netherlands government in pursuing the revitalization of the Dutch North Sea, which we think has a huge amount of potential, particularly in this asset base. So I think everything for us is quite positive, and we're certainly looking forward to the closing mid-year or hopefully earlier as we complete the transition activities. Next, let me just address our 2025 guidance. This does not include NOBV. At the time that we close, we'll include NOBV in a revised guidance for 2025, reflecting the NOBV production and CapEx into a new guidance level. So without NOBV, we plan in 2025 a 3 gross, 2.3 well drilling program. These are all horizontal wells at Leduc Woodbend in the Ellerslie and Glauconite formations. They'll be unfracked horizontals. A couple of these will be multilaterals. The inventory that we have at Leduc Woodbend is quite strong. It includes all those previous Rex wells that we have. We just have kind of turned away from those for the time being because we can get higher returns out of these less expensive unfracked horizontals, as you saw with the results that we had in the Q4 drilling in the Ellerslie. We've got a number of zones available, particularly the Rex. There are remaining Ellerslie and Glockenites, we believe, and also a few Sparky wells that can be drilled. So nice multi-zone development, and I think we can keep the Canadian asset moving up in production and throwing off quite a bit of free cash flow at the field level, even after the CapEx that we employ to have it grow. The other drilling intended for this year is in the non-operated Netherlands position. Towards the end of the year, we expect the L10 Malachite well to be drilled. That will be a 0.214 net well to Tenaz. And I think in our production guidance, we've budgeted about 1 month of production out of the Malachite well. At the corporate level, a combination of Canada and this non-operated Netherlands, we expect to generate about 10% production growth. We will have a capital level for drilling and development of 30 to 34 million Canadian and an additional 1.7 million of evaluation CapEx that would go into the L10 CCS project to take it through the feed stage and to allow us to get to the point ultimately of final investment decision on that project. The other activities in the company are the operational transition for NOBV that I've already talked about. And of course, we have our efforts in advancing our M&A pipeline in a variety of jurisdictions, and I'll speak briefly to that at the end of the presentation. In the charts, we represent, first of all, the production mix. In the pie chart, this again, without NOBV, is less weighted to TTF than we will be after closing that transaction. With respect to hedging, we illustrate in the table in the upper right that we've got a variety of gas hedges in place for the, first of all, in the top half of that table, for the non-operated Netherlands position. These are at relatively strong prices as compared to what we see in Canada. And then we've also hedged a significant percentage of our AECO exposure in the lower half of that table. Those, of course, at quite a bit lower prices than you would see for the European production. We recently did place a couple of years of AECO hedging. It's going to be roughly half our projected production at about $3.17 Canadian per MMBTU. So a fairly meaningful in terms hedge that we placed, and we wanted to take advantage of having over $3 pricing there in what has historically been a pretty weak market. And then on the slide, I've already spoken to the guidance with respect to CapEx on the lower right, 30 to 34 million Canadian, and production growth of around 10%, which leads to 2,900 to 3,100 BOED production guidance range at the mix that is shown in the pie chart. So that is our 2025 guidance without NOBV included. The next point, very briefly, I'll speak to the Tenaz record since we executed the recap. On the two bar charts at the bottom, we show about a threefold increase in production as of 24 versus the level that Altura had been at. Organic growth in Canada and inorganic growth in the Netherlands non-op position, again, does not include NOBV. And about a 10x increase in funds flow on the lower right, 24 compared to Altura. And that's really driven by higher production and increases in prices, better netbacks in the mix. It's not really addressed on the slide here in the graphs, but as I mentioned earlier, we have negative net debt now of 10 million. Altura was in a few $1 million net debt position, so an improvement there. We have retired 7.6% of the shares to date. We announced in February of this year that we were renewing our NCIB program, so that is in progress. And the stock price performance reflected in the graph on the upper right, the recap at $1.80, recent close of about $12 a share. If you look at just the 24 period, as I talked about earlier, it was a 250% TSR at the top of the E&Ps on the TSX and quite high in the top percentile of the entire TSX list. So we're very happy with that performance. We intend to continue to have the drivers. Our intention is to move these in the right direction, higher production and higher FFO, and then with the potential that might be translated into share price performance. The final slide I have, again, I intend to cover this pretty briefly, is just a summary of what we do at Tenaz, our model, or really our vision for the company. And as always, we show on the map in the dark blue jurisdictions, the ones that we would consider for potential investment. The other light blue ones are ones that are not suitable for us for investment, although we have experience in those light blue countries. And as before, we're targeting both oil and gas, primarily internationally, Europe first of all, and Latin America second. And it can be offshore or onshore production. We have expertise in both. Both have their advantages and disadvantages. We will pursue conventional production. We also like to have a semi-conventional option where possible. Typically in the overseas market, that's not something that is really has to be paid for in the initial consideration, often exists in the strat column, and we can pursue it while still producing the conventional reservoirs that we are buying production in. We like the international market because we still find it to have less competition and a greater opportunity for operational improvements once we take over operatorship. Combination of those two, we would expect to give us higher returns on capital than we could make just in North American acquisitions. So we're continuing this model. We have a pretty active acquisition or transaction pipeline, as we call it. We are continually adding new projects to that pipeline. Sometimes projects will drop out, but we think that overall our transaction pipeline is getting more mature and improving over time and expanding in size. So we're happy with what we have. Quite a bit of the effort in the company in the Calgary office is directed toward evaluating and attempting to negotiate those transactions when we get positive responses out of potential sellers. And we're just going to continue that effort and hope to bring in additional transactions that add value to the company in the same way that, for example, we feel NOBV will, or the recent Canadian acquisition that led to this multilateral drilling. So that concludes my presentation. We all of us at Tenaz and the employees and directors of the company, thank you for your interest in the company. And we look forward to having the opportunity to talk at our Q1 update. Thank you.